Why $5,000 gold matters. Now, gold reclaiming the $5,000 level is not a routine market milestone. It is a signal event, one that reflects a deeper shift in how capital interprets monetary stability, political risk, and long-term purchasing power. In prior decades, such price levels might have been dismissed as speculative excess or inflation-driven distortion. In the current environment, that interpretation no longer holds. The move represents a reassessment of trust. Gold does not rise in isolation. It rises when confidence in competing monetary instruments weakens. At $5,000, the metal is no longer reacting to short-term policy noise or temporary geopolitical stress. It is responding to accumulated structural pressures that have been building quietly across the global financial system. This is why analysts describe the momentum as intact. The language is deliberate. It signals continuation, not exhaustion. Historically, major repricing events in gold have coincided with moments when prevailing monetary frameworks began to fracture. In the 1970s, it followed the breakdown of fixed exchange rate discipline. After 2008, it reflected the normalization of emergency monetary policy. In the early 2020s, it responded to the permanent integration of fiscal expansion into monetary operations. Each period shared a common trait. Capital recognized reality before policymakers acknowledged it. What distinguishes the present moment is scale. A $5,000 gold price implies not merely inflationary pressure, but a repricing of currency credibility itself. It suggests that markets are discounting future purchasing power loss over long-time horizons, not short-term price instability. This is a critical distinction for decision makers. Inflation can be cyclical. Credibility erosion is structural. Silver's concurrent 6% surge reinforces this interpretation. Silver historically behaves as a confirmation asset rather than a leading indicator. It lags gold during the early stages of monetary stress and accelerates once confidence shifts from paper claims toward tangible value. Its sudden strength is not random volatility. It reflects broadening participation in a revaluation process already underway. The relationship between gold and silver matters because it reveals depth. When gold rises alone, it can be interpreted as defensive positioning by institutions. When silver follows decisively, it signals that the reassessment is spreading beyond narrow hedging behavior into broader capital allocation decisions. The move suggests that markets are no longer debating whether conditions warrant protection. They are adjusting portfolios accordingly. The phrase bullish momentum intact carries analytical weight precisely because it avoids emotional framing. It does not imply enthusiasm. It implies structural alignment. Momentum remains intact when the underlying drivers, monetary expansion, sovereign debt accumulation, and geopolitical fragmentation, continue to reinforce the same directional outcome. At present, none of these drivers have reversed. In several cases, they have intensified. Gold at $5,000 also reframes the role of price ceilings. For years, psychological thresholds were treated as resistance levels, points at which enthusiasm would fade and reversals would follow. That framework assumes a stable reference currency. When the reference unit itself is under pressure, thresholds lose their limiting function. Instead, they become validation points confirming a new valuation regime. This is why attempts to interpret the move through traditional technical analysis alone are insufficient. Chart patterns explain behavior only when underlying assumptions remain constant. Today, the assumption of long-term currency stability is precisely what markets are questioning. Gold's rise is not a bet on scarcity alone. It is a judgment on policy trajectory. For the business community and emerging entrepreneurs, this distinction is crucial. Gold is often mischaracterized as a hedge against fear. In reality, it is a hedge against miscalculation. It responds when decision makers underestimate the long-term consequences of short-term solutions. The current price action suggests that such underestimation has become systemic. Silver's surge amplifies the warning. Unlike gold, silver is embedded in industrial supply chains. Its price reflects not only monetary concerns, but also real-world constraints. When silver moves sharply alongside gold, it indicates that monetary stress is beginning to intersect with production realities. This convergence has historically preceded periods of capital repricing across multiple asset classes. The signal, then, is not about metals, it is about measurement. Gold and silver are revealing what currency-based metrics increasingly obscure. They are translating complex policy outcomes into a single interpretable variable: trust. At $5,000, gold is not forecasting collapse. It is indicating adjustment, an adjustment that rewards foresight and penalizes delay. This first signal event does not demand panic. It demands attention. Markets rarely issue clear warnings. When they do, they arrive quietly, framed in neutral language, and supported by price action that resists dismissal. Gold reclaiming $5,000 is one such warning. Silver's confirmation suggests it will not be the last. Monetary pressure points. What central banks can no longer control. To understand why gold and silver are repricing simultaneously, It is necessary to examine what has changed beneath the surface of monetary policy. The prevailing assumption for much of the modern era has been that central banks possess both the tools and the credibility to stabilize economic cycles. That assumption is now under strain. The metals market is responding not to a single policy error, but to the cumulative limits of intervention. Central banks operate through signaling as much as through action. Interest rates, forward guidance, and balance sheet operations are designed to shape expectations. When those expectations align with outcomes, credibility is reinforced. When they diverge persistently, markets begin to seek alternative reference points. Gold's rise suggests that this divergence has widened beyond what policy communication can contain. One of the primary pressure points is debt saturation. Sovereign debt levels across advanced economies have reached magnitudes that fundamentally constrain policy flexibility. High debt does not merely limit future options, it reshapes current incentives. Policymakers become increasingly reliant on accommodative financial conditions to sustain fiscal solvency. This reliance weakens the credibility of commitments to monetary restraint, regardless of official rhetoric. In such an environment, interest rates lose their traditional signaling power. Rate increases, when they occur, are interpreted as tactical rather than strategic. Markets understand that sustained tightening would destabilize debt servicing costs, asset valuations, and government budgets simultaneously. As a result, policy moves are discounted quickly. Gold, by contrast, does not rely on promises. It responds to outcomes. Balance sheet expansion presents a second constraint. What began as an emergency response has become a structural feature of the financial system. Central bank asset holdings are no longer temporary distortions. They are embedded components of market functioning. Liquidity provision has shifted from exceptional to expected. This shift alters how capital evaluates currency durability over long horizons. Official inflation measures further complicate the picture. While headline inflation may fluctuate, the deeper concern for long-term capital holders is purchasing power erosion over decades, not quarters. Even when consumer inflation moderates, the cumulative effect of prolonged monetary expansion remains. Gold's valuation reflects this long-term arithmetic rather than short-term relief. Silver's behavior reinforces this interpretation. As both a monetary metal and an industrial input, silver is sensitive to liquidity conditions and physical constraints. Its sharp move suggests that markets are beginning to price not only monetary dilution, but also supply-side rigidity. When liquidity expansion collides with finite production capacity, price stability becomes increasingly difficult to maintain. Another pressure point lies in policy coordination. Modern monetary systems assume a degree of alignment between fiscal authorities and central banks. In practice, this alignment has tilted decisively toward fiscal accommodation. Central banks may retain operational independence, but their policy space is increasingly shaped by government financing needs. Markets recognize this asymmetry, even when institutions avoid acknowledging it publicly. This recognition shifts capital behavior. Instead of treating currencies as neutral units of account, investors begin to evaluate them as policy instruments, subject to political constraints. Gold AS, neutrality, becomes more valuable precisely because it is not governed by domestic mandates or electoral cycles. Its rise reflects a preference for assets outside discretionary systems. The phrase, "what central banks can no longer control," does not imply institutional failure in a dramatic sense. It refers to diminishing marginal effectiveness. Each additional intervention achieves less stabilization while introducing greater long-term distortion. Over time, this imbalance becomes visible through asset repricing rather than policy announcements. Importantly, markets are not reacting to a single jurisdiction. The move in precious metals reflects a global reassessment. Competitive devaluation, divergent growth trajectories, and geopolitical fragmentation all contribute to a landscape in which no single currency offers unquestioned refuge. Gold benefits not because it promises growth, but because it offers insulation from policy convergence risk. For business leaders and capital allocators, this environment alters strategic assumptions. Cash, traditionally viewed as a low-risk reserve, becomes an active exposure to policy outcomes. The opportunity cost of holding depreciating units increases as confidence erodes gradually rather than suddenly. Gold's ascent highlights this cost without requiring dramatic crisis narratives. Silver's participation underscores the breadth of the shift. When an asset with significant industrial demand begins to move in tandem with monetary hedges, it suggests that liquidity dynamics are affecting real economy inputs. This connection matters for cost forecasting, supply planning, and long-term investment decisions. Taken together, these pressure points explain why precious metals are responding now. The system is not collapsing, but it is recalibrating. Central banks retain influence, but not omnipotence. Markets are adjusting to that reality incrementally, using gold and silver as reference instruments. The signal is subtle, but its implications are structural. Ever wonder where the big money is really going? While most of us are watching the daily ups and downs of popular stocks, a quiet but massive shift is happening behind the scenes. The smart money, the huge institutional funds that move markets, is making calculated adjustments to their portfolios. This isn't about chasing quick trends, it's about strategic positioning for the long game. Today, we're pulling back the curtain to reveal how these financial giants are quietly preparing for what's next. What do they know that we don't? Stick around, because understanding their moves could be the key to navigating your own financial future. So, what exactly is this quiet adjustment? It's a subtle but significant rotation in institutional portfolios. For months, the market has been driven by a handful of mega-cap tech stocks, the so-called Magnificent Seven. But now, institutional investors are starting to look beyond the obvious winners. They're not necessarily selling off their tech holdings entirely, but they are trimming their positions and reallocating that capital into sectors that have been overlooked. Think about areas like industrial manufacturing, energy, and even certain segments of the financial sector. Why the change? It's all about risk management and value hunting. The concentration in just a few stocks has created a potential vulnerability, and smart capital always seeks to diversify before a potential downturn. They're relooking for undervalued assets with strong fundamentals that are poised to perform well in a different economic environment. Let's break down where the money is flowing. First, there's a renewed interest in the old economy. Industrials, for example, are gaining traction. These are the companies that build the physical world: machinery, infrastructure, and logistics. With talks of reshoring manufacturing and massive government spending on infrastructure projects, institutional investors see a long-term growth story here that isn't tied to the latest tech hype. Similarly, the energy sector is back on their radar. It's not just about oil and gas anymore. The transition to renewable energy sources requires immense investment in new technologies, grid upgrades, and raw materials like copper and lithium. Institutions are placing bets on companies that will power our future, whatever form that energy takes. It's a classic value play. Find solid sectors that have been out of favor but have a clear path to future demand. Another key area is the healthcare sector, but not in the way you might think. While biotech and pharma always get attention, the smart money is also looking at medical devices, healthcare services, and insurance providers. These businesses tend to be less volatile than drug development companies and benefit from a non-negotiable demographic trend: an aging global population. As people live longer, the demand for consistent healthcare services, from routine checkups to surgical equipment, is virtually guaranteed to increase. This provides a stable defensive backbone to a portfolio, offering resilience even if other parts of the economy slow down. It's a strategy focused on steady, predictable growth rather than explosive, high-risk gains. So, what's the big takeaway for you, the individual investor? The key is to think like an institution, even if you're not managing billions. Don't get caught up in market noise or chase the hottest stocks. Instead, pay attention to these broader underlying shifts. Ask yourself, is my portfolio overly concentrated in one area? Am I overlooking sectors with solid long-term potential simply because they aren't grabbing headlines? You don't need to copy every move these funds make, but understanding their strategy, diversification, value hunting, and focusing on long-term fundamentals is incredibly powerful. The quiet adjustments of smart capital are a signal. They're a reminder that successful investing isn't about frantic action, but about thoughtful, strategic positioning. So let's get right into it. We all know the tech giants have been the stars of the show for years. Names like Apple, Microsoft, and Nvidia have driven huge returns. But here's the catch. What happens when everyone is crowded into the same trade? The big money is getting a little nervous about having all their eggs in one tech basket. A single bad earnings report or regulatory news could send shockwaves through their entire portfolio. So what's the smart money doing? They're starting to look abroad. We're seeing a strategic shift towards international markets, especially in emerging economies. Think about places with growing middle classes and booming domestic demand. These markets offer a different kind of growth story, one that isn't so tied to what happens in Silicon Valley. It's a classic diversification play, spreading the risk while hunting for new opportunities. Now, what does this mean for you, the retail investor? First, don't panic and sell all your tech stocks. But it is a great time to review your own portfolio. Are you overconcentrated? Maybe it's time to follow the institutional lead and add some international exposure. You could look at ETFs that track global or emerging market indexes. This is a simple way to get broad exposure without having to pick individual foreign stocks. Remember, the goal is to build a resilient, balanced portfolio that can weather any storm. In a world of constant economic shifts, are you, as a business leader or entrepreneur, truly prepared for what's next? Today, we're diving deep into a topic that could fundamentally reshape your business strategy: the repricing of gold and silver. This isn't just about commodities, it's about the future of money itself. For decades, we've operated within a fiat currency system, where money's value is based on trust in the government that issues it. This system has fueled incredible growth, but it's also showing signs of strain. Think about it. Massive national debts, relentless inflation, and a global financial system that seems increasingly fragile. Now, imagine a world where gold and silver are not just seen as safe haven assets, but are repriced to reflect their true monetary value. This isn't a far-fetched fantasy. Throughout history, whenever fiat systems have faltered, societies have returned to assets with intrinsic value. Gold and silver have been the ultimate form of money for thousands of years. So, what does a repricing event actually mean? It's not just about the price on a screen going up. It signifies a massive transfer of wealth and a fundamental reset of the global financial order. For business leaders, ignoring this potential shift is like sailing a ship without looking at the weather forecast. The first major implication is currency volatility. As a repricing event looms, you can expect wild swings in the value of fiat currencies like the dollar, euro, or yen. This creates immense uncertainty for businesses engaged in international trade. Your revenue from overseas could be worth significantly less overnight, or the cost of your imported raw materials could skyrocket. How do you navigate this? One strategy is to start diversifying your corporate treasury. Holding all your cash reserves in a single currency is a high-risk bet. Consider allocating a portion of your treasury into physical gold and silver. This isn't about speculation. It's about preserving purchasing power. When currencies devalue, the value of gold and silver priced in those currencies tends to rise, acting as a natural hedge. Let's talk about supply chains. A global monetary reset will disrupt them, guaranteed. Trade relationships will be redrawn. Countries with strong gold reserves may find themselves in a more powerful negotiating position. As a business leader, you need to audit your supply chain for vulnerabilities. Are you overly reliant on a single country for critical components? It's time to explore localization and diversification. Building more resilient, shorter supply chains can be a game changer. Next up, pricing strategy. In a high inflation environment leading up to a repricing, setting your prices becomes incredibly difficult. If you don't adjust them quickly enough, you'll be selling at a loss in real terms. Dynamic pricing models will become essential. Some businesses might even start pricing their goods and services directly in grams of gold or silver, bypassing volatile fiat currencies altogether. This might sound radical, but it offers stability in an unstable world. Think about your contracts. Long-term agreements based on a fixed fiat currency price could become a liability. You might deliver a service today for a payment tomorrow that's worth far less. It's crucial to review all contracts and consider adding clauses that adjust for monetary inflation or link payments to a stable measure of value, like a commodity index or even gold itself. What about access to capital? During a financial reset, credit markets can freeze up. Banks become risk-averse, making it harder to get loans. Businesses that are debt-free and have strong cash flow, especially if some of that cash is in the form of real assets like gold and silver, will be in a much stronger position. They won't just survive, they'll have the opportunity to acquire struggling competitors and assets at bargain prices. This brings us to a crucial mindset shift for entrepreneurs. The game might change from chasing growth at all costs, funded by cheap debt, to building robust, profitable, and resilient businesses. The focus will shift from paper profits to real, tangible value. Your business's balance sheet will become more important than ever. What are your real assets? What are your liabilities? A strong balance sheet with low debt and tangible assets is your best defense. Let's consider the psychological impact on consumers. When people lose faith in their currency, their behavior changes. They rush to spend their money before it loses more value, or they hoard essential goods. This creates both challenges and opportunities. Businesses that provide real essential value, food, energy, security, durable goods, will thrive. Those selling discretionary or frivolous items may struggle. Understanding the shift in consumer psychology is key to adapting your business model. Now, let's break down some actionable steps you can take right now. First, educate yourself. Don't take my word for it. Study monetary history. Understand why gold and silver have always been money. Read about past currency resets. Knowledge is your most powerful tool. Second, perform a stress test on your business. How would your company fare if your home currency lost 50% of its value in a year? What if your key supplier went out of business? What if you couldn't get a loan? Identifying these weaknesses now gives you time to fix them. Third, start building a position in physical gold and silver. Start small. Think of it as an insurance policy for your business. It's not about getting rich quick. It's about staying in the game. Owning the physical metal, not just paper contracts or ETFs, is crucial for ultimate security. Fourth, innovate your business model for resilience. Can you reduce your reliance on long, complex supply chains? Can you create more flexible pricing? Can you build a stronger relationship with your local community? Businesses that are agile and adaptable will be the winners in this new paradigm. Fifth, network with like-minded entrepreneurs. Build a community of people who understand what's happening, share strategies, insights, and resources. In times of great change, a strong network is invaluable. You're not alone in this. The repricing of gold and silver isn't a doomsday scenario. It's a reset. And with every reset comes incredible opportunity for those who are prepared. It's an opportunity to build stronger, more ethical, and more sustainable businesses based on real value, not financial engineering. It is a chance to move away from a system built on debt and toward one built on sound money. For entrepreneurs, this is a call to action. Don't wait for the crisis to hit. The signs are all around us. The time to prepare is now. By understanding the strategic implications and taking prudent steps, you can not only protect your business, but position it to thrive in the economy of tomorrow. You can become a leader in your industry, providing stability and value when others are lost in the chaos. This isn't just about business, it's about securing a future for your employees, your family, and your community. The shift is coming. The question is, will you be a victim of it, or will you be one of the architects of the new landscape? The choice is yours. Start preparing today. Thank you for joining us on this critical discussion. If you found this information valuable and want to continue exploring the future of money and finance, make sure to subscribe to our channel, GS Boring Currency. We appreciate your time.